Joining us now, Joe Terranova, Senior Managing Director at Virtus Investment Partners and a CNBC contributor. So is it the 10-year that's raising eyebrows for stock traders, Joe? And if so, what is happening with the 10-year? What's it telling us?
Good morning, Joe. Well, we've been trying to figure out the riddle that has been messaging from the 10-year since the middle of June when it fell post-FOMC from 1.59 down to 1.30. Good luck figuring out what the reasoning behind that is. I think more important, Joe, is positioning. Was anyone really positioned for that type of move, or was the overwhelming majority expecting a 2% print for a U.S. 10-year Treasury? So you're seeing a dramatic repositioning underway as it relates to the equities market. Understand that we're coming off all-time highs posted just yesterday. And then overnight, we get the news from Chinese policymakers that there will be a reversal in their policy stance because they're concerned about growth. Their view is that growth is slowing, and now that they're witnessing that, they're talking about loosening some policy, taking the reserve ratio requirement and actually allowing that to be lower and have banks to be provided with more liquidity to put forth for their customers and small businesses.
The Fed is, on one hand, I hear something, sort of rumblings about a plan to come up with a plan to maybe take something away. And then on the other hand, I hear, we're very aware that this is, the economy is not a slam dunk. We have this great rebound, so we're ready to provide assistance if needed. They're saying both, and I think they need to.
Well, Joe, they've been saying both since the great financial crisis. For the better part of the last 10 years, a 10-year Treasury, which has averaged 2.3%, has only spent 90 days above 3%. So we've heard that rhetoric from the Federal Reserve for many, many years. It's the deflationary impact of an intangible asset economy. The technology dominance within our economy is just creating an environment where we're going to see below trend economic growth, and I think that's the challenge we have here in 2021 as we normalize the abnormalities of 2020, and I think the expectations for above trend economic growth were a little misplaced. Where's that organic growth going to come from, Joe, when the fiscal spending fades?
Right. Does that mean, we have people that think we're spending too much, and we have people, again, nobody agrees. People are spending too much, and other people think we're not spending enough. I think if you spend too much, that's going to be bad for bonds. But then if you don't spend enough, then the economy doesn't recover quickly. It's like everything. You can make a case for either side.
Well, I think ultimately it means monetary policy remains present in
fiscal?
Giving the liquidity to the capital markets.
Are people watching this
fiscal policy
stuff and then another $6 trillion after that? When does that become an issue in terms of higher rates? That's what I don't understand, how that eventually doesn't cause an increase in borrowing costs, which would really be a problem, but not yet.
Well, yeah. Not yet. Not yet. We've had that expectation for many, many years. I think what's important to focus on is the continued presence of monetary policy. Joe, ask yourself the question. The size of the Federal Reserve balance sheet grew 100% from 2008 to 2009. Is that Federal Reserve balance sheet ever going to go back to where it was in 2007?
Shepard Smith here. Thanks for watching CNBC on YouTube.